You are looking at your grocery bill this morning and wondering if there has been a mistake because the numbers do not make sense. You are standing at the gas pump watching the counter tick up faster than it ever has before and asking yourself how a policy designed to put America first has immediately made your life significantly harder. We need to talk about what happened overnight because while the headlines are screaming about a trade war and political posturing, the real story is happening in your wallet, and it is happening because of a fundamental misunderstanding of how global trade actually works. You were told that tariffs are a weapon used to punish foreign countries and force them to play fair. But what you are experiencing right now is the economic reality that economists have warned about for decades, which is that a tariff is not a bill sent to a foreign government. It is a sales tax charged to you at the register. When the president signed that order initiating a total trade war, the intention was framed as a strategic move to bring jobs back and assert dominance, but the immediate mechanism was a shock to the global supply chain that is now rippling through every single transaction you make. I want to walk you through the mechanics of this because it is easy to get lost in the political noise and miss the structural shift that has just occurred in our economy. When we talk about a tariff, we are talking about a tax on imports, and it is crucial that you understand exactly who pays that tax. It is not the foreign exporter sending goods to our shores. It is the American company importing those goods. If a business brings in steel or electronics or clothing, they are the ones writing the check to the US Treasury, and because businesses exist to make a profit, they do not just absorb that cost, they pass it on. They pass it on to the distributor, who passes it on to the retailer, who ultimately passes it on to you. That gallon of milk that doubled in price is not just reacting to speculation, it is reacting to the sudden increase in costs for everything involved in getting it to the shelf, from the fuel in the delivery trucks to the aluminum in the processing machinery. This is what we mean when we talk about cost push inflation, where the price of producing goods rises and pushes up the final price for consumers. You might be hearing the White House describe this as temporary pain for long-term gain, but we need to analyze that claim critically because for families living paycheck to paycheck, the concept of temporary pain is a luxury they cannot afford. When prices double overnight, it is not an inconvenience, it is a crisis that forces you to choose between gas to get to work and food for your table. We have to look at why this happened so fast, because usually economic policy takes months to filter down to the consumer, but this was different. The global markets react instantly to uncertainty and risk. When the announcement was made, the value of the dollar on international markets took a nosedive, not because the United States suddenly became less productive, but because the faith in our trade relationships shattered. A weaker dollar means that it costs more of our currency to buy the same amount of goods from abroad, which compounds the effect of the tariffs. So you are getting hit from two sides at once. First, the tariff itself adds a direct cost to the goods, and second, the weakened dollar means the base price of those goods in our currency has effectively risen. This is why you are seeing prices skyrocket literally overnight. It is a feedback loop of policy decisions clashing with market realities, and unfortunately, you are the one caught in the middle. We need to dissect the list of products that are doubling in price because it reveals something very important about the structure of our modern economy, which is how deeply integrated we are with the rest of the world. You cannot simply flip a switch and isolate the American economy without severing the complex web of supply chains that keep our shelves stocked and our businesses running. Small businesses are the canary in the coal mine here. You might see the closed signs going up in your town and think it is just a reaction to panic, but for a small business owner, this is a mathematical impossibility. They operate on thin margins and they rely on predictable costs. If the cost of their inventory jumps by 50 or 100% overnight, they do not have the cash reserves to cover it, and they certainly cannot double their prices without losing all their customers to the big box stores that can afford to weather the storm for a little while longer. This is where we see the disparity in power within capitalism. Large corporations have the capital and the logistical networks to stockpile goods or renegotiate contracts or even shift their supply chains over time, but the local shop on Main Street does not have those options. they are forced to pay the higher prices immediately or shut their doors. So when we look at this trade war, we have to ask who is actually being punished. The rhetoric says it is foreign nations, but the reality on the ground shows us that it is the American consumer and the American small business owner who are bearing the brunt of this policy shift. We are going to go deeper into how this affects your savings and your future, because the drop in the stock market is not just a problem for Wall Street, it is a problem for anyone with a retirement account or a pension plan. When the market dives, it erodes the wealth of millions of households and creates a sense of instability that causes people to pull back on spending, which in turn hurts the economy even more. It is a vicious cycle that starts with a policy decision and ends with a recession if it is not checked. We need to understand that the economy is not a machine that you can fine-tune with a sledgehammer. It is an ecosystem that relies on balance and trust. When you introduce a shock of this magnitude, you disrupt the delicate balance of incentives and prices that allows the system to function. You might be feeling angry or confused right now, and that is a rational response to seeing your purchasing power evaporate. We are told that this is necessary to protect American industry, but we have to examine the evidence and ask if protectionism in the 21st century actually protects workers, or if it just insulates inefficient industries while punishing everyone else with higher prices. I want to take a step back and look at the broader context of why this policy was chosen. There is a belief among some policymakers that trade is a zero-sum game, where for one country to win, another must lose. This worldview leads to policies like aggressive tariffs, because the goal is to capture a larger slice of the pie rather than growing the pie for everyone. But economics teaches us that trade is generally positive sum, meaning that when countries specialize and trade, both sides can be better off. By rejecting this principle and embracing a conflict-based approach to trade, we are essentially choosing to make the entire global economy less efficient, and that inefficiency manifests as higher prices for you. It is a tax on efficiency and a tax on cooperation. We are also seeing a failure to appreciate the complexity of modern manufacturing. A product made in America often contains components from a dozen other countries. If you tax those components, you make the American-made product more expensive to produce, which makes it harder for American companies to compete globally. This is the paradox of protectionism, where trying to save domestic jobs can actually destroy them by making domestic industries uncompetitive. You need to pay attention to how this narrative develops over the next few days, because there will be a lot of noise about patriotism and toughness. But patriotism does not pay the grocery bill, and toughness does not lower the price of gas. We need to focus on the cold, hard numbers and the structural reality of how these policies extract wealth from the working class and transfer it to the state in the form of tariff revenue or to protected industries in the form of higher prices. This is a redistribution of wealth, but not the kind that usually gets discussed. It is a redistribution from you, the consumer, to the government and to specific corporate sectors that benefit from less competition. As we continue, I want to look specifically at the automotive and technology sectors, because they are going to be hit particularly hard, and that is going to affect everything from the car you drive to the phone in your pocket. We are witnessing a dismantling of the trade infrastructure that has defined the last 30 years of economic growth, and we are stepping into a new era of economic nationalism that prioritizes political goals over economic stability. Let us look at the car in your driveway, because it is the perfect example of how this policy fails to understand modern manufacturing. You might think of a Ford or a GM vehicle as purely American, but the reality is that the automotive supply chain is one of the most complex global networks in existence. Your car contains thousands of parts, from semiconductors to sensors to specialized steel components, and many of these are sourced from across the border or across the ocean, not because American companies do not want to buy local, but because the specific expertise or capacity exists elsewhere. When you slap a blanket tariff on all imports, you are effectively taxing every single one of those components. The transmission that was assembled in Mexico using US steel and German electronics now costs 20% more to bring back into the country for final assembly. Who pays that 20%? The manufacturer pays it first, but they cannot absorb a hit that massive, so they pass it to the dealer, and the dealer passes it to you. We are looking at sticker prices on new vehicles jumping by thousands of dollars overnight, not because the car is better or the workers are getting paid more, but simply because the government has inserted itself into the supply chain to extract a fee. This is a direct extraction of value from your bank account to the federal treasury disguised as patriotic economic policy. Now consider the phone in your pocket or the laptop you use for work. The technology sector is built on a foundation of global trade and thin margins. These devices are assembled from components made in a dozen different countries, and the logic of their production relies on the seamless movement of goods. When you disrupt that movement with tariffs, you do not just raise prices, you disrupt the entire production schedule. We are already hearing reports of tech companies delaying product launches or scaling back production because they simply cannot calculate their costs anymore. This is the hidden cost of trade wars, which is uncertainty. Businesses hate uncertainty more than they hate high taxes. When a business does not know what its costs will be next week, it stops hiring, it stops investing, and it stops expanding. So even if you do not buy a new car or a new phone this week, you are still affected because the company you work for might be the one freezing its hiring budget in anticipation of the economic slowdown. This is how a trade policy that sounds tough on television ends up translating into a stagnant job market in your community. We also have to talk about the retaliation because a trade war is never a one-sided affair. When the United States imposes tariffs on foreign goods, those countries do not just sit back and take it. They respond with tariffs of their own targeting our most sensitive industries. Historically, this means they target American agriculture. They know that farmers are a politically important constituency, so they slap massive taxes on American soybeans, corn, and pork. Suddenly, the farmers in the Midwest who were told this trade war would help them find that their biggest export markets have slammed the door shut. This leads to a surplus of crops rotting in silos and a collapse in commodity prices here at home. The government then usually has to step in with bailouts or subsidies to keep those farms afloat, which means your tax dollars are being used to patch the holes created by the very policy that was supposed to fix the economy. It is a circular transfer of wealth where the government breaks your leg and then offers you a crutch paid for by your own wallet. You are paying higher prices at the store for imported goods, and you are paying taxes to subsidize the industries hurt by the retaliation. It is a lose-lose scenario for the average citizen. The ripple effects extend into the construction industry, which affects the cost of housing. Lumber, steel, and aluminum are the raw materials of shelter. We are already in a housing affordability crisis where millions of Americans cannot afford to buy a home or are struggling with skyrocketing rents. By increasing the cost of construction materials through tariffs, we are pouring gasoline on that fire. Developers will pull back on new projects because the numbers no longer pencil out, which restricts the supply of housing even further. If you are trying to buy a house or even just rent an apartment, this trade war is directly working against you by making it more expensive to build the inventory we desperately need. This is another example of how macroeconomic policy connects directly to your personal financial security. The price of steel on the global market might seem abstract, but when it stops an apartment complex from being built in your city, it drives up your rent. We need to see these connections clearly to understand the full weight of what has just happened. There is also a deeper structural issue here regarding the role of the dollar. As I mentioned earlier, the dollar initially weakened due to lost confidence, but there is a counterintuitive force at play as well. If the global economy slows down significantly because of this trade war, investors often flee to safety. And ironically, the US dollar is still seen as the primary safe haven asset. If the dollar strengthens again due to a global flight to safety, it makes our exports even more expensive for the rest of the world to buy, which acts as a double whammy for American manufacturers. They get hit with tariffs on their raw materials, making production more expensive, and then a strong dollar makes their finished goods too expensive for foreign buyers. This is how you hollow out the manufacturing base of a country. You squeeze them from both ends while claiming to save them. It is a policy tragedy born of a misunderstanding of currency markets and industrial economics. You might be asking why any administration would pursue this if the economic consensus is so overwhelmingly negative. The answer lies in the difference between political logic and economic logic. Politically, tariffs sound like a strong, decisive action. They frame the economy as a battleground where we can defeat our rivals. It appeals to a sense of national pride and a desire to see domestic industry return to a golden age. But economics is not about battles. It is about incentives and efficiency. You cannot legislate the clock back to 1950. The world has changed, technology has changed, and the structure of production has changed. Trying to force the modern economy into an old model breaks the machine. We are seeing the gears grind to a halt right now. The closed signs on small businesses, the spike in gas prices, the panic in the stock market, these are the sounds of the economic machine breaking under the strain of a policy that ignores reality. We need to consider the impact on your savings and retirement beyond just the daily stock market fluctuations. Pension funds and 401k plans are heavily invested in multinational corporations because those companies have historically provided stable returns. When you declare war on global trade, you are declaring war on the profitability of the very companies that millions of Americans rely on for their retirement security. A sustained trade war compresses corporate profits, which leads to lower stock prices and lower dividends. If you are planning to retire in the next few years, this is a direct threat to your standard of living. You are being asked to sacrifice your financial future for a political experiment that has failed every time it has been tried in history. From the Smoot-Hawley tariffs of the Great Depression to the steel tariffs of the early 2000s, the lesson is always the same. Protectionism leads to higher prices, lower growth, and increased economic isolation. Let us look at the energy sector specifically because you noticed the gas pump ticking up. The energy market is global. Oil prices are determined by global supply and demand. A trade war slows down global economic growth, which usually lowers demand for oil, but the uncertainty and the disruption to supply chains can cause price spikes. Furthermore, the equipment used to extract and refine oil in the U.S. relies on imported steel and specialized machinery. If it costs more to drill and refine, it costs more to fill your tank. The energy independence we talk about is relative. We are still part of a global pricing system. You cannot wall off the American energy market from the rest of the world without severe consequences. When the price of energy goes up, the price of everything else goes up because energy is an input in every single good and service produced. Food production relies on diesel for tractors and natural gas for fertilizer. Transportation relies on fuel. Retail relies on lighting and heating. Energy is the lifeblood of the economy, and when you constrict the flow or raise the cost, you slow down the entire body. The psychological impact on the consumer cannot be overstated. When you see prices jump and the news is filled with talk of conflict, you naturally pull back. You delay that vacation you put off buying that new appliance you cook at home instead of going out. This drop in consumer confidence is a self-fulfilling prophecy. As spending slows, businesses see revenue drop and they cut costs, usually by cutting labor. We could be looking at a recession not caused by a fundamental flaw in our productive capacity, but caused entirely by a policy error. This is the tragedy of the situation. We had a functioning economy with issues, certainly, but functioning. Now we have introduced a massive distortion that is forcing everyone to scramble. The winners in this scenario are few and far between, usually limited to specific protected industries that can lobby for exemptions, while the losers are the vast majority of American consumers and workers. I want to talk about the concept of deadweight loss, because it is a term economists use to describe the value that is destroyed by inefficient taxes like tariffs. It is the wealth that simply vanishes. It is the trade that does not happen, the job that is not created, the investment that is not made. It is invisible in the sense that you do not see a line item for it on your receipt, but it is very real. It represents a lower standard of living for society as a whole. We are voluntarily choosing to be poorer to satisfy a political narrative. And we need to ask ourselves if that price is worth paying. Is it worth paying double for milk to send a message? Is it worth risking your job to prove a point? These are the questions that the administration is not asking, but they are the questions you have to answer every time you open your wallet. As we move forward, we need to analyze the institutional breakdown that allowed this to happen. Congress has largely ceded its authority over trade to the executive branch over the last few decades. The Constitution gives Congress the power to regulate commerce with foreign nations, but through various acts and emergency powers, presidents have accumulated the ability to impose tariffs almost at will. This concentration of power removes the checks and balances that are supposed to prevent rash economic decisions. We are seeing the result of that imbalance now. One person can sign a piece of paper and change the price of every product in America. This is a failure of our political institutions to safeguard the economic well-being of the citizenry. It highlights a dangerous drift away from democratic accountability in economic policy. You did not vote for higher gas prices. You did not vote for a stock market crash. But because of how our system has evolved, you are subject to the whims of executive power in a way that the founders never intended. In the next part of this analysis, we are going to look at the specific winners and losers in more detail, and we are going to talk about the long-term structural damage this does to the U.S. standing in the world. Because when you break trust with your trading partners, you do not just lose a contract, you lose the ability to shape the rules of the global economy. And that is a loss that will haunt us long after these specific tariffs are gone. We are dismantling the architecture of American economic leadership, and the vacuum we leave behind will be filled by others who do not share our values or our interests. But first, we need to understand exactly how the money moves in this new tariff regime and why the government creates a dependency that is hard to break. Let us follow the money because that is where the structural reality of this trade war reveals itself most clearly. When the government collects these tariffs, billions of dollars are flowing from the private sector into the United States Treasury. Remember that this money is coming out of your pocket through higher prices, but it is ending up in the hands of the state. This creates a perverse incentive structure where the government becomes addicted to the revenue or uses it to play favorites. We are already seeing the administration hint at using tariff revenue to fund other projects or tax cuts, but you have to look at the math. They are taking money from working class families at the grocery store to fund initiatives that often benefit the wealthy or the politically connected. It is a regressive tax disguised as trade policy. A regressive tax is one that hits lower income people harder than higher income people. If you earn $30,000 a year, a doubling of milk and gas prices is a catastrophe. If you earn $3 million a year, it is a rounding error. So when we talk about a trade war, we are talking about a policy that disproportionately crushes the poor and the middle class while leaving the capital class relatively unscathed or even empowered to buy up distressed assets on the cheap. This brings us to the concept of rent seeking, which is a term economists use to describe when a company tries to increase its wealth without creating any new wealth, usually by manipulating the political environment. In a high tariff regime, the most profitable investment a corporation can make is not in research and development or better machinery, but in lobbying. If a steel company can convince the president to keep foreign steel out, they can raise their prices without improving their product. They capture value from you, not because they are better, but because they have purchased protection from the state. We are moving toward an economy where success depends more on who you know in Washington than on how well you serve the customer. This corrupts the very heart of the market system. It turns the economy into a game of political patronage where the government picks winners and losers based on which industries are politically useful to the ruling party. You end up paying for this corruption every time you buy a car or an appliance that costs more than it should.